You're listening to Scaling Up Services, where we speak with entrepreneurs, authors, business experts, and thought leaders to give you the knowledge and insights you need to scale your service-based business faster and easier. And now, here is your host, business coach Bruce Eckfeldt.
Are you a CEO looking to scale your company faster and easier? Check out Thrive Roundtable. Thrive combines a moderated peer group mastermind, expert one-on-one coaching, access to proven growth tools, and a 24/7 support community. Created by Inc. award-winning CEO and certified scaling up business coach Bruce Eckfeldt, Thrive will help you grow your business more quickly and with less drama. For details on the program, visit eckfeldt.com/thrive. That's ECKFELDT.com/thrive.
Welcome, everyone. This is Scaling Up Services. I'm Bruce Eckfeldt. I'm your host. Our guest today is Nelson.tepfer, and he is Regional Director for the Greater New York area for the CFO Center. We're going to find out a little bit more about their business. We're going to talk to Nelson about what service companies typically get right and get wrong when they think about their finances and think about strategy. I'm excited for this. I think finances are often a very overlooked element to scaling businesses in general, and particularly service-based businesses, understanding how money flows, understanding how profitability works, understanding how to be strategic around looking at your finances and setting up your books. Learning about your business through money is great. So with that, Nelson, welcome to the program.
Thank you. Great to be here.
So why don't we talk a little bit about your background first, and then we can talk about the CFO Center, and then we'll talk a little bit about what you've learned being an advisor to businesses and what you've learned about service-based businesses. So what is your background? How did you get into the work that you're doing now?
So I was the CFO of a company for about 11 years when a friend of mine reached out to me and said a friend of his is having some trouble with his company. Can I have a conversation, maybe see if I can help? So I figured, no problem. I'll help out a friend of a friend. I'll have that conversation. And that conversation turned into a year-long interim CFO role. And what I learned by doing that was that the skills which I had in my regular corporate role is so much more impactful to these small and middle-sized businesses. It's so much more engaging for me to work at. I learned an entirely new business and a new industry, and now I'm able to bring all the skills that I had in my previous role to have a real impact on a company like this. So I started doing more work like that for the next about 6.5 years, working across 8 or 9 different industries, helping clients, helping businesses grow, to helping them achieve their goals, taking the skills that I had in my previous role to this level. And then I wanted to take what I was doing to the next level, so I joined the CFO Center as a second member of their New York team. I took over the team about a year later, and we're now up to 12 CFOs in the region.
So you manage the team of CFO service providers in the Greater New York area. So it's kind of like you have a business within a business here. And just talk to us a little bit about what the services are in terms of what you do, what you don't do, why you've kind of chosen that particular suite of services to provide to the market.
Sure. So we provide part-time CFO services to companies that don't want, or cannot afford a full-time CFO. In almost a decade of doing just this type of work, it's almost always don't need. Most companies simply do not need a full-time CFO sitting on their payroll in their office for the most part. They need that level of experience and expertise to help guide them, to call on as a resource. But they don't need that person sitting there full-time. Here in the New York region, a full-time experienced CFO is very expensive.
Yeah.
And making sure, you want to have that resource available when you need it, but you don't necessarily need them there full-time. And we stick to that CFO role. We don't do the company's books. We're not the company's accountant. We stick to that CFO role and helping guide them on their strategic growth from their financial perspective.
Yeah. And maybe for the audience, let's just talk through the different roles here, because people talk about bookkeepers, people talk about controllers, people talk about accountants, people talk about CFOs. Just tell us a little bit about what those different roles mean, why and when you need those different roles, and then how the CFO role is really different from all of those, and how that kind of ties more into strategy and overall business management and business planning versus, just kind of entering checks and reconciling accounts.
Absolutely. So usually the first hire in this type of space is an accountant or a bookkeeper. We'll start with the bookkeeper side for the moment because that's internal. That first bookkeeper role is obviously supposed to just make sure everything is recorded. That everything in the business has to be recorded somewhere. And this is a very crucial one, which we've often seen is one which is kind of abused a position in the company.
not physically abused. I mean,
No. I mean, the role is
bookkeepers coming to you with bruised and battered.
Too much. Yeah, no. You ask them to do too much without the proper guidance, very often because the business owner doesn't have the guidance to give them.
Yeah.
So that bookkeeper is asked to do quite a bit. And when we very often come in, we'll see things which are just done wrong at the bookkeeper level through their fault or not. It's just certain things are done incorrectly when it comes to recording certain aspects.
Anything that's come up for you? I mean, I'm just kind of curious what things you've seen in terms of, just fundamental mistakes or things that end up hurting a business later if they don't get right in the beginning.
Oh, absolutely. Properly recording obligations, breaking it down between interest and principal or interest and principal. So little tiny things like that. Yeah. We worked with one company where this was a little bit more extreme, obviously, where they just simply stopped doing bank recs about 6 months before I started talking to them. Yeah. Because their bookkeeper did not know how to enter into their system the Amazon reserve, where to record that. So they just stopped those bank recs about 6 months before I got there.
Yeah, that's not good.
And she didn't have anyone she could turn to from guidance. The business owner, he's a programmer, engineer type background. He doesn't know about the account type of thing. So there are a lot of things like that. We're just making sure that knowledge flow is there. It's someone that they can go to where they have questions that they can actually get answers to do. Because very often, if they don't know where to go, they'll either do something wrong or just won't do it.
Yeah. Yeah. All right. So that's bookkeeper. That's just keeping the records, making sure that you have entries for everything that's happening in the company from a financial point of view. Talk to us a little bit about then I'm kind of curious how a bookkeeper typically works with an accountant, why your accountant is not your bookkeeper and why your bookkeeper is not your accountant. Talk to me about that a little bit.
Sure. So your accountant, most businesses, when they start to have some type of accountant, it's usually somebody they know or someone that gets referred to them. That person obviously is there to make sure their taxes are filed correctly for the most part. When you're first starting out, that's usually the first role of that accountant. Now, one challenge we very often see business owners take is they'll give their accountant certain directives, but their accountant will just take their directives and try and make it fit instead of actually being proactive in guiding that business owner where they should go when it comes to a tax strategy perspective.
Yeah.
When we work with a company, for instance, where their business owner, young, inexperienced when it comes to business, built a very successful business very, very quickly. But he told his accountant that he doesn't want to pay that much taxes. Well, no one really does, obviously. But what the accountant didn't tell the business owner is that there are ramifications if your returns are always showing you're not really making all that much money.
Yeah.
As in, he couldn't get a real line of credit from a bank, as in that caused cash flow issues later on. So, making sure that accountant is your true business partner and someone you can actually work with is really, really important. Making sure you have the right value for that professional relationship. Yeah. That accountant's role is more on the tax planning side. Obviously, you want to pay less taxes, but there are ways to do it that still paint the pretty picture for your company.
Yeah. Yeah, I've seen that happen as well. Like you've had 5 great years of not paying a whole lot of taxes, but then you go to get a line of credit or you go to at a transaction, like you have an opportunity to sell the company and someone looks at the books and says, well, why I shouldn't pay a whole lot for this thing because it's not making money. And you're like, well, no, but it really is making money. Trust me.
Yeah.
And then becomes this game of what's the value of the business. So.
Absolutely. Yeah. So the right professional really helps guide that because we have ones where it's just simply not the right working relationship we see where they're not consulting their accountant on equipment purchases. Yeah. When we worked with a client where I asked him, he's asking about an equipment purchase, and I asked him if he spoke to his accountant, and he tells me, why should I speak to my accountant? It's not time for me to file. Yeah. So I said, okay, great. Let's call your accountant, then let's find you a new one. And he saved, I think it was $30,000 or $40,000 just by buying in December instead of January.
Yeah, exactly. Yeah, putting it depending on which year you put it into and what the tax liability is. Yeah. And so then talk to me about controller, because I think this comes up a lot. How does a controller work? What is that function, and how does it fit with some of these other ones?
Sure. So, the controller differentiating from a bookkeeper, the bookkeeper is more on what we refer to as, there are 3 layers in your finance function. There's your support function, your operational, and then your strategic. The bookkeeper and the accountant play more in the support function. Okay. They're there just to make sure things are recorded, things are filed. You have some tax strategy, obviously, on the accountant side. The controller's role is really moved more into the operational. And that's where how processes actually work within an organization usually falls more on the controller side when it comes to how bills are paid, how, all those things like that. It's their responsibility to maximize, what the company has when it comes to those types of things. Their role, put simply, is probably more of that gatekeeper that most people, which is to make sure as much money as possible comes in and as little as possible goes out.
Yeah. Keep the bathtub full.
Exactly. But, when it comes to, they should have a better sense of where the profitability of the company is. Yeah. How certain things actually flow through that organization. Cash flow management usually should fall on the controller level. Now, what we've very often seen is that those get mixed up with the bookkeeper or somebody who is a controller ends up in a CFO's seat. And that's where things start to get a little bit different and break down a little bit.
Yeah.
Because they'll have certain information or certain perspectives on how certain things are supposed to happen. But the CFO stepping into that role and to differentiate it a bit or two, the CFO's value is really at the strategic level.
Got it.
Very often they may step down to the controller level to help with certain things, but you very rarely see a good controller step up, moving to the strategic.
Yeah.
You have seen a few, and it's really great when you do see it and you come across them, but it is difficult, and that's why the lines are usually a little bit drawn around that. So that controller level is more, put simply, is probably that gatekeeper. It's probably the best way to define that responsibility in a growing organization. Cost savings, those types of things like that. Those will typically fall under the controller's level.
Yeah. So then let's talk about the CFO role and kind of what it entails, when a company typically needs to consider, some level of a CFO role, either, fractional, outsourced, or internal. And what does that CFO do? Who do they work with? What are the goals of having a good CFO in place?
Sure. So more broadly speaking, that role of that CFO is, as I mentioned, at the strategic level. And that'll come across in a few different key areas. That's when it comes to developing goals and strategy for the organization as a whole and helping map out the activities to help you achieve it. For instance, we worked with a company where, they had grown very successfully. They're now, when we started talking to them, I was like, okay, great. Where are we trying to go now? And it was adding a certain number to top line revenue over the next 3 years. So we worked with that company to identify what are the activities that they need to do to help them achieve that. And for that particular company, it was they needed to hire 5 salespeople over the next 6 months to achieve that goal of top line revenue. They had the operational throughput to handle it. We were able to assess that. We were able to go through something like that. So with that, it was helping identify those actual activities to help them achieve their goal. Yeah. And that's really where you start seeing that CFO is, for instance, if you want to add to that growth, which areas of your company are more profitable? Where should you be focusing your efforts on growth? Because just adding top line revenue sounds really good, but if it's not contributing to your growth,
it's not profitable revenue. Yeah, exactly. Yeah.
And we've run into that absolutely a lot when it comes to making those types of decisions and firing customers that are not profitable.
Yeah.
We run into that a lot. And even when there are significant portions of overall revenue, but being able to assess those costs accurately, it's not just direct costs, but the indirect costs that are involved there as well, that will allow you to take those steps to helping you achieve your goals.
Yeah. I think that information becomes crucial. I was just actually running sessions this week with a company, and we were kind of digging into who is their best customer and who should they go out and get more of, who should they sell more of. And one of the things I asked them is, okay, well, who's your most profitable customers? And they can often do it at a kind of gross margin level. They can figure out, okay, well, what are the direct costs that I have with this client? But then we start asking about, well, how much time does it take, of your operations folks? Like how invoicing, is it a pain? And do they, keep sending it back? And you've got to spend a lot of time, coming up with new cost breakdowns and stuff like that. Like if you really start mapping your contributing operational costs, overhead costs to, by client, fairly quickly, some of these clients become actually not profitable. and you're better off just firing them.
Oh, it really does. We literally had an example of that where Walmart was actually one of our customers clients, and they're a legacy client, and have to keep Walmart. It's about 25% of their revenue. And the conversation basically came down to, as you mentioned, they were able to get their gross margin numbers, like, oh, this is there, it's profitable over there. I was like, sure. How much of your time? How much of these 3 people's time? And how much of this time are they going through it? Let's add those salaries to the equation as well. A percentage of that. And when you start putting in all of these information, Walmart just simply was not profitable.
Yeah.
And even though it was 25% of their revenue, they realized that they had to let them go in order to continue to grow and achieve their goals.
Yeah. Well, and it goes back to, I think, one of the reasons to actually, at least consult with a CFO, early in your business process is making sure that your data entry, the information you're capturing, whether it, financial, time, things like that, making sure that you've got it captured in such a way that you're actually able to do that analysis, because if you're just dumping all of your expenses into a general expense category, when really they probably need to be mapped to project codes or, client codes so that you can figure out really what is your net profitability on a client by client or a project by project basis. Like if you don't have that data, it's really tough to do it retroactively.
Absolutely. That goes back to the old adage, what isn't tracked can't be measured.
Yeah.
If we can't track the information as you need to make the decisions, there's no way you can make the decision based on that. You can't measure your results without it.
Yeah.
So absolutely we get involved in designing those systems, what would work, what wouldn't work, what you need to track, what you don't. Working with the company recently where it's like, okay, we want to grow. We have 3 avenues of growth. I was like, that sounds good. Are you tracking the effect of those 3 different avenues inside your company currently?
Yeah.
No. So how do we actually measure that? So we have to come up with a way of saying, okay, these are the 3 channels of revenue. This is how we're going to track each one. This is how we're going to track the efforts we're putting into growing each one. And these are how we're going to track the results.
Yeah. And I like that it's more than just the checks that you write and the credit card purchases and things like that. It's your time. It's time that you're putting into it. I mean, because basically time is money, right? Like if you're spending time on something, that's a resource that you need to manage. And the other one I constantly run into is when they kind of figure out how much time an individual is spending on an account, and they do it as a percentage and they do it as 40-hour weeks. But then I talk to the person, I say, how much do you work? And they're like, I typically work 55, 60-hour weeks. I'm like, okay, well, so what's going on with this other 15, 20 hours? And they're not really capturing that you're losing information around what it's really costing you. And they may say, well, look, but I pay this person's salary. I'm not really paying for the extra time. And generally I say, look, you're paying for it one way or another, right? Whether you're paying for it, in terms of the bonuses you have to give, or, if they leave and you've got to rehire somebody because you've overworked them. I mean, those are costs that are going to come up someday in some shape or form. So you better capture it now so you really have a good accounting of what is it costing you to do these projects and work with these clients.
Absolutely. And tying this specifically to a service one we worked with, I was working with the managing partner of a law firm, where I basically told them, I was like, look, if we change over the way your internal processes work to free up between 3 and 4 days per month for you to just get out there and sell. Right? Managing partner of a law firm, they're the rainmaker of the firm. And I said, if we do that over the next 6 months, what do you think you can generate? And he came up with a number, and it was a pretty high number because he's really, really good at what he does. And I said, great, if we come up with these are what it will cost you in order to do that, that becomes a much clearer conversation. This is how much it costs. This is how much you think you can generate. Let's go do it. And that's really what it came down to. And he cleared his goal within like 4 months of that, once we actually implemented those changes on the operational level.
Yeah. Well, like I said, I think that's a good strategic CFO will help you set up those things so you can make those decisions and hopefully be more profitable and increase revenue. So talk to me a little bit about some of the other challenges you see, particularly around service-based businesses. When you're coming, you mentioned law, professional services, other service-based businesses where, people's time or people are a core part of the value that's delivered. What are some of the kind of challenges, mistakes, missed opportunities that you see companies when you come in and work with service-based companies?
So we've very often seen the issues that pop up really comes around the quality of people that they choose to bring into their firm, or into their organization, especially now with such a tight talent pool that just end up settling for talent. And when you're talking about that, these are the people, the revenue drivers of your firm, and you have some people operating at this level and other people who are here, it really creates a very big problem for the continued growth of that firm. And this is especially true when you're talking about everything is so tight these days and the growth trajectory is here, and suddenly they hit a wall and they don't understand why. And it really comes down to a skills gap very often, where it's just everybody, half the people are here and everyone else is here. Yeah, you're going to hit that wall. You're going to plateau when you get to a certain level because you don't have the rest of the players at the right level. That's probably one of the most pervasive I've seen. And the answer is usually, well, we needed the person. And I'm like, I understand that, but Harvard, I believe, did that study in one of their HBS case studies where a toxic employee has a more of a detrimental effect than a star employee actually has adding. So the settling for talent is really, really one of probably the biggest stumbling blocks I've seen many service-based industries do, because their people are their growth. Their people are what's driving their business, and they settle for talent.
Well, and you said it. Typically they're under the gun, right? They've sold a project, or they're working on a strategic project, and someone leaves, or they need a resource, and they've got to get a player on the field, and so they make kind of a battlefield hire, which short term, I get it, but a couple of months down the road, a year later, they're now saddled with a C player in an organization. The one stat that I like, and I can't remember where, I'll find the source for it, but the performance is always an issue, right? The productivity of C players is obviously very low, but the thing that I find being the big reason, or the one that I end up quoting that really drives a lot of leaders in terms of making better decisions, is that the number one reason A players leave a company is because they have to deal with C players. So it's not really the C player's lack of performance that's the issue. Is that if that C player in the business causes you to lose an A player, that's where the pain is. And
Absolutely.
so, making those decisions, first of all, making good hires is the solution to it ultimately. But, if you do end up having a C player, the real reason to take action sooner rather than later is that you don't want to risk losing your A players.
Absolutely. Well, one other area we typically see, challenges on is the design of certain processes within organizations end up being by default instead of by design. Like the way certain processes actually flow through information. It's like, well, that's the way we did it because this is where we were, and now we've grown to here, so we just kind of evolved into that. Except you take a step back, and it's like, well, this doesn't really make sense anymore. And the best example I have of that to work for the company is to take them 4 to 6 weeks to send out an invoice after they finish the project. You know what that does to a company's cash flow? That's just brutal. Yeah. And it happened because basically their process was it had to go through 6 different departments before they can send it out.
Yeah, they've got to sign off on it.
Yeah, and then so I started looking into why. Why is it take this? So why does it need to go through 6 different departments? And the answer was because they were a fraction of their size. One person had all 6 responsibilities. And the person used to just do it and sign off. And as the company grew, very, very nicely they grew. But now they took the responsibilities and created this team. This responsibility goes to this team and this team and this team and this team. They really had to go through all 6 of them before someone would actually kind of sign off and send out that invoice.
Yeah.
So we redesigned that process to now within 5 days. But that's a very typical one we've seen where if you're not reviewing these internal processes and procedures, it's a very big stumbling block towards actually that continued growth trajectory.
Yeah. I'm curious about, one thing that I run into a lot with business, certainly service-based businesses, is kind of pricing and pricing strategy. Anything that you've seen or models that you've seen people take in terms of how to figure out how to price products, services, programs, how to go from, well, this is what it costs me in terms of the labor, the people involved, versus this is what I should charge the client for. Any thoughts or ideas or suggestions you can give people, either in terms of figuring out really what your costs are, because I think that's a challenge sometimes, but also figuring out then, how do I actually go to a pricing model, or what are some strategies around how to price services when you go to market?
Sure. So usually it comes down to, when it comes to the pricing strategies, I very often say, let's start with the end result. Yeah. What profit do you want to make off of this type of thing? What's your net profit? And usually try and start with net instead of gross, because there are so many factors that play into that contribution margin and those operating costs involved in calculating that net. Yeah. That's where you really need to start, because we work with companies that were operated on a 40% gross margin. Yeah. Guess what their cost of overhead was? 40%. So, if you're not starting with the net, then your pricing isn't going to help you make any money if you're not starting with that net result. Yeah. So a lot of it comes down to is, okay, if this is where you want to be at the end of it, then you have to kind of work backwards over here and to come up with that number. And if that number that you get to is something that none of your clients are going to pay, then obviously there's an issue there you need to figure out that requires a little bit more deeper understanding.
Yeah.
Because you have to start with the numbers where you're trying to get to, and then work backwards from there to say, okay, this is what's acceptable, this is here. With regards to pricing structures, we have seen companies get very creative and actually create more problems than they were trying to solve when it comes to some of their pricing structures. Yeah. I'm a big fan of simple. Yeah. Keep things as absolutely simple, as universal, and as across the board as you can, because you're always going to have that one person in the organization who didn't quite understand the complications of that particular pricing issue, and you're going to have to deal with that later. So keep things as simple as possible across the board.
Yeah. Oh, I've seen projects quickly go unprofitable because someone inadvertently gave a discount on something that they shouldn't have because of the nature of the project. The other one I like that idea of kind of starting with the end in mind. I think a lot of companies kind of figure out, okay, well, they kind of price it, and then they figure out what it costs, and whatever's left over is profit or loss, depending on how well they've done this. And I like that idea of reverse engineering, of just saying, hey, look, well, what's our target? Are we trying to make 10% net, 15% net, 20% net, and then figure out, okay, well, given what our costs are, where do we need to price to be able to have that in our hands at the end of the project? And then, and if we're not getting that, if we can't meet that price, well, we've got to figure out how to increase the value so we can get that price, or change our expense model. Maybe we need to figure out how to lower our cost of being able to deliver that same thing to the customer. But yeah, I think too many people end up, profit is just an end function rather than a target that they're thinking about and planning around.
It's also very much an understanding that very often needs to go into that equation is, when you're changing the price, what is the effect of changing that number at the end? Yeah. And there's very often a miscommunication between those two numbers. Oh, sure, if I just add this number over here, then this is going to go up like this. Well, is it? What else is involved in making that conversation? Yeah. And that's why you need to have both the beginning and the end in mind when you're creating your price.
Yeah. I think the one thing that I certainly have found, a lot of companies or a lot of leaders, founders, CEOs and it happens maybe 20, 30% of the time, they're just hesitant to increase prices. And I think it's a function of they're worried about they're going to lose the sale and things like that. I think one thing that I've found is pushing people on price as much as possible, meaning that they're typically undercharging at some level. And so even if you can increase price by 5%, even if you lose a client or two, because an increase in price drops directly to profit, right? Assuming that all other expenses are the same, it hits directly to profit. You can often make up a couple of lost clients by increasing price just because you're adding so much profit to the bottom line for everyone else. And I think a lot of people leave money on the table.
Absolutely. That's almost universally from what we've seen. Yeah. Almost universally. And I'm talking about across industries, across sectors, it's just almost always they're leaving money on the table because they don't understand their pricing structure, how it affects to it, and the actual dynamics in the marketplace.
Yeah.
To exactly your point, those slight increases in price add so much more to the bottom line than keeping that more customers. So it's just make sure you understand that and understand those relationships. Yeah.
The strategy. What's the whole revenue is vanity, profit is sanity, cash is king, right? Like it's really making sure you understand how those things fit together.
Absolutely.
So I'm curious in terms of companies that have thought about hiring a CFO, a fractional CFO, someone like you. What are the things that they should be looking for, things they should keep in mind? How do they interview? How do they select a good partner? What's the process you recommend people follow, questions that they ask, criteria that they use?
So for starters, it has to, we would always recommend that there has to be someone who's actually held that level of responsibility and role in their past.
Okay.
That is one of the key things we've seen. Very often they don't because they're price conscious. They don't want to pay that much for that level of experience, except if you put someone in that role who hasn't really done it before, you're not getting what you need very often from their value for that strategic level.
Yeah.
If that person hasn't answered to the CEO, hasn't answered to the board, hasn't had P&L responsibility in their past, then yes, they may be great, wonderful, brilliant people. Mm-hmm. It's just the level of experience that gets that title, and it's the level of experience that's what you should be paying for.
Yeah.
For short of that, you're just not getting the value.
Yeah. No, I think getting a lot of it is you're paying for the experience of having been through that process, or ideally having been through the process as a company, double your size, so you actually have someone can lay out a roadmap of saying, okay, well, you're here now, twice what you're at right now looks like this, and this is the steps, and here are all the problems you're going to run into, and here's how we're going to get through them. Yeah,
absolutely. So we've very often seen that need come up. It's interesting. It's not a dollar amount revenue. It's more of an evolution of a company when we see that need pop up.
Yeah, that's interesting. It's like the company dynamic, number of clients, number of people.
Sure. I've seen it happen at $500,000 in revenue, and I've seen it not happen until $50 million in revenue. Yeah. Really, it depends how the company's built, how the CEO, how the management team is set up as to when that evolution needs to happen to bring in that level of experience and expertise.
Yeah.
And very often they'll see these challenges come up when they hit that wall, they hit that plateau, and it really just is a skills gap in at that level.
Yeah.
And so it's how you address that skills gap in the best way for the company.
And when you start an engagement or when you start working with a company, like what does the process look like? What are the first things you do? Ongoing, how do you interact? How often you're meeting with them?
As I mentioned, we see that level of split across that support, operational and strategic. Very often when we start with companies, we actually start with the support because that's kind of our foundation. You mentioned making sure the books are done and done right.
Yeah.
Because we can't make any decisions based on that if it's not.
Yeah.
So that's one of the first things we'll tend to look at is how is data captured within the organization to make sure that the information we're looking at is actually accurate. That's also one of the ones we'll look for making sure the risks of the company is correctly managed when it comes to from an insurance side or general business risks that they're keeping an eye on the things that are happening in their industry. That's usually where we'll start. And there's also usually some type of pressing need when somebody calls us, which is obviously being addressed right away, whether it's cash flow or internal systems and processes. There's usually some type of problem going on, or they're no longer profitable and they don't understand why. These are typical types of challenges when we get brought in, which is what we start working with quickly. In regards to how often we are there working with clients, that really varies by clients. Some of them were there half a day every hour of the week. Some of them were there 4 days a week. It depends what's going on and what they need us to do and how we can help.
Yeah. Yeah, good. If people want to find out more about you, about the CFO Center, what's the best way to get that information?
Sure. So our site is www.thecfocenter.com. I can be reached at Nelson.tepfer at thecfocenter.com for any questions you may have.
Great. I'll make sure that those links and your email is in the show notes here so people can click through and get that. Nelson, this has been a pleasure. I always love talking strategy, particularly around finance and companies. I think it's one thing that people get afraid of, unfortunately. I think they don't spend enough time in. So I think we covered a lot of good stuff, a lot of good value for the audience. Thank you for taking the time.
Absolutely. Thank you very much, Bruce.
You've been listening to Scaling Up Services with business coach Bruce Eckfeldt. To find a full list of podcast episodes, download the tools and worksheets, and access other great content, visit the website at scalingupservices.com. And don't forget to sign up for the free newsletter at scalingupservices.com/newsletter.